Okay, guys, let's go ahead and wrap up this chapter 11 discussion. And we're going to finish up with the discussion of segment reporting. So I broke chapter 11 into two sections. You may have already seen the foreign currency one, foreign transactions, foreign currency discussion in a separate file that I've posted on iLearn under chapter 11. And now this will be the last part of chapter 11, segment reporting. So throughout this class, we've been talking about consolidations and the process for consolidating, taking company A and company B, company C, whatever, and consolidating them into present a company that is under common ownership. Well, that's not really the way companies manage their day-to-day operations. What a company would do is it would basically be looking at its European division, its Asian division, its U.S. division, its product XYZ divisions, and sit there and look to see that those are profitable, et cetera, and making their business decisions. Well, FASB took a look at that and said, well, look, since the company has this information and this information is available, they should disclose some of that segment information so that the user of the financial statements can look in the notes and whatnot and see what some of the day-to-day or some of the, I don't know about day-to-day, but some of the details that the company uses to manage, make those available to users as well. So what they did was they sat there and they said, okay, look, CEO, CFO, you have all that information on your desk. You should be providing some of that to the users. The CFO, CEOs look and say, you mean I have to provide everything on my desk? No, just the big stuff. Okay, so the moral of this little story here, the thing to keep in mind as we go through this little story is a couple of takeaways. One is that companies do not have to report every single thing, just the big things that they use to manage the company on a day-to-day basis. And then the other takeaway is that it's information that's on their desk. They don't have to create new information in order to provide this segment disclosures. Okay, so it's not like they're going to have to generate a whole new set of information. It's information that they already have, and it's the big information that they have. What segments are big enough to have to be reported? Okay, now when we look at segment information, it is important here to note that we will need to be providing or using the same accounting principles as the main financial statement. So there's an expectation that you'd use, for example, accrual accounting on both the segment information and, of course, for our consolidated statements. We're going to see that when we're determining a segment, we are not going to be eliminating intercompany transactions. So when we report a segment, we don't eliminate intercompany sales, and we identify whether a segment is large enough to have to be reported, we will not eliminate intercompany transactions. You'll see that in some of the examples that we have coming up. Now, when we are reporting, we're reporting operating segments. Therefore, things like corporate headquarters, things like pensions are not considered operating segments. It's those that have results, engage in business activities, etc., where discrete information is available. Again, the point being that the entity does not have to sit there and come up with a whole new set of information in order to comply with segment reporting requirements. It's, hey, what do you already have, and is it big enough that we expect you to report it? Of course, is it an operating segment? So you can see that they're telling us here, look, it is information that the chief decision maker, okay, the CFO, I guess is what they're trying to say there without actually saying it, is an information that the chief decision maker has available that they use to make different decisions about what's going on with the company. Okay. All right, good. So now our main job here is to figure out whether or not a segment is big enough to have to be reported as a segment. And it turns out that there are 10% size tests that FASB has given us. One is a revenue test, One is a reported profit or loss test. One is an asset test. Okay, so any segment that has revenues, reported profit or loss, or assets that are bigger than greater than or equal to 10% would have to be reported as a segment. And they don't have to meet all three of these. Only one of these, revenues, profit or loss, or assets, have to constitute 10% of the overall, each one of these, revenues, assets, reported profit or loss, in order to be considered large enough to be a segment. It's any one of these. Okay, so segment revenue, including both sales to external customers and inter-segment sales, okay, is 10% or more of the combined revenue, internal and external, to all operating segments, then they have met the 10% test. So what will we do? We'll take all the revenue. We don't eliminate intercompany transactions. We take all the revenue, add it together for all the segments, multiply that number by 10%, and then we'll go through each segment to see if they have revenue that is greater than or equal to that 10% number. If it is, it's large enough to have been reported as a segment. Let's look at assets. We'll do the same thing with the assets. We'll combine all the assets of all the segments, multiply that number by 10%, go through the list of segments and see if they have assets that are greater than or equal to that 10%. So even if a segment didn't meet the 10% test based on revenue, it could meet it based on assets. Okay, and then we have the reported profit or loss test. And the key thing here is that we keep in mind that we're talking absolute amount. Okay, so we're going to take all the profitable segments, put them together, add their profit together, take all the loss segments, put them in a column, add those negative numbers, those losses together, multiply the profit total by 10%, multiply the loss total by 10%, and then whichever one of those gives us the larger absolute value becomes our threshold to determine the profit or loss for the to determine the profit or loss size that would be big enough to constitute reporting of a segment. Okay, now that one gets a little bit confusing. So what I want to do right now, before we sort of find ourselves a little bit lost, let's see. Well, hang on, stay a little bit confused for 1 second. I'm going to show you all this and some problems here in a couple of minutes, but let me just do this 75% reporting sufficiency test part. We have to have enough segments, okay, that we have now presented at least 75% of the consolidated revenue of the consolidated company. So if you go through these tests and the segments that you've identified using the 10% test do not constitute 75% now of the consolidated revenue, then there's an expectation that you will continue to add segments until you represent at least 75%. Okay, now as a practical limit, they tell us 10 segments might be sufficient as a practical limit. In other words, if you start getting to a point where you have now destroyed the understandability of the financial reports by providing too many segments, then stop. And as you know, they don't give us a hard number, but they're saying 10 is sort of a not a precise, but a practical limit as to the number of segments you should report. Okay, so what I want to do now is go to some of the quiz questions that are posted up on iLearn. So let's just go to that file. Okay, and first let's do this question. We're going to do two here. First this one, and we're going to practice sort of a pretty straightforward question. I don't know if it's easy, but it's straightforward. Okay, so we have these different segments, and we want to figure out which of these would have to be reported using and notice, guys, they do not tell us, they say a revenue test, but you need to make sure that you're clear that those tests are 10% tests. Okay, so you take the combined revenue. You do not eliminate the intersegment revenue for this. Okay, and again, this could be assets as well that we'd be doing something like this, but this one contemplated revenue, but they're all 10% tests. We multiply that by 10%. That gives us 8,300 as our threshold. Okay, now we go through and we look at our segments to see which ones are big enough to be reported as a segment. Now when we look, again, we don't worry about the eliminating intercompany transactions. We just sit here and look at the total. And so aloe is not big enough. Bix is. C is not. Dill is. Okay, so the answer to this question then is what? Only Bix and dill would be reported as a segment. And you can see that down here. Now, we still, though, are required to do that 75% sufficiency test. I mean, we know we got this question right, but let's just see how we would apply that 75% test. So now we look at what? Now we look at the consolidated, okay, sales to unaffiliated customers. So we would, of course, have eliminated the intercompany transactions, and we want to look to see that we have presented at least 75% of the consolidated. Okay, so 60,000 is going to be our denominator. Our numerator is going to be what? It's going to be this, and we go to the unaffiliated column, 43,000 for dill, and what, 8,000 for Bix, the two that we've identified. What, 43 and 8 gives me 51,000, right? And so then I would go ahead and take that 51,000 here, and I'm going to go ahead and just put it in my calculator because I don't trust my math skills, as you well know. 51,000 divided by 60,000 gives me 85% right on the dot. Okay, well, I only needed to represent what? 75% of the external consolidated revenue, so I'm good here. So Bix and dill will be the two that I would have to report. Okay, all right, good. Now let's come over, and I think there's another question. I'm not going to do that one, but there's another question somewhere in here where you had to make every segment a segment, even though they didn't all meet the 10% test, because if you didn't include that segment, you wouldn't meet the 75% sufficiency test, and that's probably the only way you'd have to. They could give you, I could give you a question where you'd have to add in a segment, because at some point, it starts to become, well, just add them any way you want in order to meet the 75%. So typically a question that's testing that 75% sufficiency rule is going to basically have you have to include all the segments to get up to 75%, if that makes sense. Okay. All right, so let's look at this next one now, and now we're using the based purely on operating results, okay? And so they're going ahead and they're giving me the profit or loss for each of these segments, and so I'm using the profit or loss test. Now, my job is to sit here and figure out first, what has the higher absolute value, the loss segments or the profit segments. So I go ahead, and I'm just going to take you straight to the answer because it's just easier to present what we would do here. Okay, we take all the loss segments. So Carter had a loss and Elbow had a loss. Well, the total of their losses are 200,000. Then we take all the profitable, Astor, B-Jax, who else did? Davis had a profit, right? Okay, so we take those from those guys, add them all together. That gives us 325,000. Now, we go ahead and we multiply each of those by 10%. Of course, we don't have to multiply them by 10% to realize that what the bigger absolute value is 32,500, right? Okay, so that becomes our threshold, not 20,000. We had multiplied the 200,000 by the 10%. That would be 20,000. 32,500 obviously is bigger on an absolute value basis than 20,000. So now we go through, and again, we do not worry about the eliminations here, and we start to identify our reportable segments. Okay, so now we look and using 32,500 as our threshold. Okay, we start looking, can see the threshold there. We start looking at yes, obviously Astor is big enough, but not BJAX. Not BJAX. Okay, Carter on an absolute value basis, even though the number is negative, is big enough, so we report that one. Davis, yes, but not Elbow. Okay, so it's Astor, Carter, and Davis are our segments. Okay, and that was the answer to the question. Astor, Carter, and Davis. So the answer B would have been the correct answer here. Okay. All right. Now you say, well, what about the 75% sufficiency test? Well, we wouldn't have to do it here because obviously we've picked out only the profitable segments. So we have more than represented 75% of our consolidated revenue here. We wouldn't have to do the 75% test in this case. Okay. That is pretty much what I wanted to say about segment reporting. Okay, let me go back to our slides. Okay. Segments that are not meeting one of the 10% tests would all be combined and reported in a column called all other segment categories. Okay, but they wouldn't have to be discretely called out. Okay, guys, that's pretty much all I wanted to say about segments. Again, I want to thank you for your patience with the situation of having to have canceled our last meeting. Hopefully this information was useful to you. Good luck on your exam if you haven't taken it yet. And as you move along, if you have any questions, you know where to reach me. Okay, guys, take care. Bye-bye.